right, hey y'all. We are back here with another Q&A with Rick Fields, Associates in Accounting, and we are just trying to, again, as we gear up for tax season, make sure that we are staying out in front of your guys' questions and answering as many as we can, giving away some free value here. So we've got a few good questions that we're going to discuss today, and we're going to pick Rick's brain and see what we can find out. So the first one here is from Tommy in Ohio. And he is asking, it sounds like Ricky owns a small restaurant up there, and he is seeing some things about federal aid potentially coming out for specific small businesses continuing to be hit by the new COVID-19 variant, and wanted to see what your thoughts are. Is it really going to happen? Is there any way to know? Kind of maybe talk us through what you've heard. And
I'm flipping a coin to tell you the answer, Tommy. This is a tough one, and it's a tough one because there is a great deal of information out there, like the articles that you see in the Wall Street Journal, and I think that was maybe your source for your question, one of your sources. There's no question there's a need. You can define the politics any way you want to. You can say we should be in the business of helping small businesses. We shouldn't be in the business of helping small business, as far as our government and our politicians and our feds. But the reality is, when things happen, like what's happened over the last 2 years, and we open restaurants and close restaurants and have supply chain issues, and we can all argue about the reasons for those. But at the end of the day, the real reality is restaurants are struggling. I live in Louisville, Kentucky. When I go into a restaurant these days, it's very rare to find a restaurant that has a wait or even most of its tables full. It's even rarer to find a restaurant that has enough employees. So the reason that I'm mentioning all of these points is that, of course, restaurants are struggling. And again, if we lined up 10 politicians in a row and asked them to explain why that's taking place, there'd probably be 20 arguments about why. They could even argue both sides of the issues as far as who it's at fault, what factors are contributing. But one thing we can agree on: profits are down, sales are down. We have a very popular hamburger restaurant here in Louisville that has been open, and closed, and they don't even have a mandate telling them that they have to close. Their first close after the mandates were lifted in our area was strictly because of staffing. They simply couldn't get enough people to service the restaurant adequately to serve food. The next one was because of COVID and COVID exposures. So the staffing got better, and then they had to send them home. So again, we all understand the problem, and I'm spending a little bit of time simply to help understand the environment in Washington that is going on. Because again, all of those arguments are taking place. We're just not privy to them, right? So we've got politicians who are blaming other politicians. We've got politicians who are blaming federal policy, blaming COVID, blaming the economy, blaming inflation. Doesn't matter what they're blaming, they're still blaming. But because there are so many arguments, the environment is not right. This is me with my magic 8-ball trying to answer your question. The environment not right at this time for them to agree. And especially with this current year being a midterm election year, there are lots of folks that want to be right so that they can get reelected. And no one really knows what right is. So I don't know. I wish I did. We have a lot of restaurant clients that would like for me to answer that question for them. The reality is we're simply helping advise our clients in how to adapt and adjust and go after the monies that are being made available as they are becoming available. You might also check in Ohio to see what local types of aid is available. Various cities and various states here in Kentucky and Indiana, which I'm a little bit more familiar with than Ohio. We have a number of clients there as well. But various states are providing grants at the state and federal level. Now, why is that happening? They got a ton of money out of the CARES Act last year. So many of them went from having huge budget deficits to actually having surpluses. So now also want to be reelected. they're spending a lot of time saying, look what we're doing for you. And here in Kentucky, especially, and in Louisville specifically, there are various grant programs available for restaurants that are being sponsored under very specific programs. So you might check that out. If there's anything we can do to answer your question more thoroughly, because I realize that my answer is somewhat vague today, but if there's anything we can do, please reach out to us and we'll be glad to discuss this further with you.
Yeah. And then something else that came to mind while you were talking is, and we're going to get to inflation a little bit later in the in this talk, but as the rates are lower right now, and it sounds like there's for sure going to be some rate hikes this year, Rick, do you think it's a good option for some of these small businesses to also potentially look into talk to their bank and see if it makes sense for them to maybe take out a loan that's not necessarily forgivable, but get it at a rate that might be more favorable than, say, a year from now?
Yeah, and you're obviously referencing interest rates and the fact that locking them in now might make a lot of sense. And I get that. And so I would simply say, yeah, there's some real merit to what you're talking about. The hard part about that is, of course, the banks also know that interest rates are rising, are likely to rise as the year goes on. And so they're tightening their underwriting a little bit. Yes,
yeah.
If there's some thought that debt might be part of your future or part of your solution, then this would certainly be the time to do that. I heard a newscast today that talked about March being the most likely target for some interest rate increases. March is 6 weeks away, roughly. So certainly it will not be long before the banks will simply tighten up and wait to see if they can charge higher rates without feeling like that they are gouging their customers. So this would be the time to reach out to a bank if you want to try to go that direction, certainly. And good luck, Tommy. This is an uncertain time for restaurant owners. We're seeing our clients both thrive and struggle. And it isn't necessarily multiple clients, but the same client that is having periods of both. So hang in there.
Yep, for sure. Definitely a tough time. You think you're right at the end of it, and then you get hit with another wave, it seems like. And
Indeed.
Then the last point I think I'll make about it is it just seems it might not even be a cash flow issue necessarily, or cash in the door, whether it's some help from the government or a loan. Goes back to one of our earlier conversations. How do you keep employees stick around and all those kinds of intangibles so that a customer still has a good experience when they come into your establishments? And there's nothing really that the government can do on that front. That's going to be some planning, and we help clients think through things like that, some strategies that they can do with fringe benefits. So again, feel free to reach out if that's something that you want to talk through and see if we can help you with. So
one final point, Jordan, because you're making a good point that's prompted one more comment.
Yeah.
We during the first 20 months roughly of the pandemic, we had very few inquiries about credits that are available to help with COVID absent employees. There are some credits that are built into these acts, and there's some question about whether they'll continue in 22 or not, but they certainly were there in 21 and 20. So if you had employees that were away from work because they were quarantined or ill, there are some tax credits available in that situation. I mentioned that simply to say, make sure you talk with your accountants about that. It encourages, if you understand it, it encourages employers, and I'm getting this question with Omicron being so contagious in so many more cases. I'm starting to get this question pretty often. Virtually everyone I've talked with has had some employees that have either been sick, quarantined, or in some other way absent because of a spouse or a child that has been. So these credits are providing some relief from the cost of continuing to pay those people when they are not in your business working. And that might be something that you could use to get your employment up a bit. Hey, we understand COVID's real. We're going to make sure that you get paid, even if you have to be away sick. But again, you need to understand how much relief you could get from the various credit programs that are out there and whether or not they're going to be carried over into 2022. Congress hasn't said anything yet, but this will be much easier for them to agree on than new packaging in a time of 7% inflation.
Yeah. Okay, cool. All righty, let's move on to the next question. So from, looks like from Stephanie in Florida, she is asking, sounds like she self-employed. Well, she's just asking if you own a small business or you're self-employed, she's asking about, can she write off the gym membership that she pays each month to, to lower her tax bill?
Yeah, I love that question, Stephanie. Boy, we all could live longer, work faster, and own our businesses forever if we all take advantage of our gym memberships, right? So it's a great question. And unfortunately, the answer is generally no. That's considered a personal expense. However, I will make a couple of exceptions, and I want you to hear me well. These are very specific situation exceptions. So I would not in any way say, oh, I heard the guy online tell me that I can do this, 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 and this. No, you need to work through these exceptions with your particular tax advisor, or talk with us directly and we can help assess your situation. And I'll give you a couple of examples about why I think there are some exceptions to the no in this question. We have a number of clients who are local news anchors here. Have you ever seen a 350-pound news anchor? The answer is no, and there's a good reason for that. Probably when you see a 350-pound news anchor, unless they have an incredibly sterling personality, you're going to turn the channel and go to the channel that has the 180-pound news anchor, assuming it's a guy, right? But my point is, they have a very subconscious, intangible requirement that they have to dress well. Their hair has to be perfect. They have to maintain certain fitness standards in order to be publicly accepted. And it's sad but true that we're that shallow and we require that, right? But we do as a viewing audience. So because of that, many of these guys spend a whole lot more money, personal trainers, various fitness routines. If they're spending a good deal of money because it is expected either directly or indirectly by their employment, they have a possibility of writing it off. Now, the problem is most of those folks are employees. And if you're an employee, and I realize you have a small business, but if you're an employee, there's nowhere to write it off anymore. So now there's a different standard that has been employed, and many of those folks have worked through some fringe benefit handling by their employers. But the philosophy is the same in your small business. Stephanie, we don't know what you're doing. If you are a personal trainer, I think that you probably are going to meet this narrow window because, frankly, again, you don't see a whole lot of 350-pound personal trainers either, right? So there's a certain fitness level that is absolutely necessary in order for you to do your job. And I believe that would likely be the case. So if you have specific within your business need, if you have a specific type of business that you conduct under your business umbrella that absolutely requires your ongoing gym membership and physical fitness, perhaps you're a construction contractor that requires particular strength and so forth in order to do the work you do. Again, if it's beyond what Jordan or I might have in terms of a gym membership, because of the specific needs of your business, there is a narrow window there that you might be able to justify. But I will tell you, the vast majority of the time, you're going to have a burden of proof with the IRS if they ever question it, to basically say, well, this matters to me based on what I do. When I realize that the whole world has a gym membership in January, most of them they probably don't use in February, but they have them in January. And unfortunately, it's not normally a business expense under the standards that the IRS says, which is ordinary, in other words, common in your business, and necessary, which again, that's the proof standard you'd have to meet.
Okay. All right. But so I'm going to play. Go ahead. Sorry.
Yeah, I like
the. Okay. So devil's advocate, and this, I've heard this from some clients before. Well, big corporations, they give all these, they work them in as fringe benefits. And I know sometimes that can be taxable, and sometimes it can be, if they have certain accountable plans and things, they can make it where the fringe benefit is not taxable to the employee. And pretty much the simple pushback is, well, big corporations are writing these off for all their employees. Why can't I do it for my small business as a fringe benefit? And is there a way to get around all of that if you say I have an accountable reimbursement plan, and even though it's me and myself as the business and the personal, is there a way that you can, with some documentation and things, to get around that and say, hey, big corporations get to do it, why can't I?
Great point, Jordan. Great point. Here's the inherent unfairness in the tax law when you're a small business. In those large corporations, if Jordan is working as a financial professional for Walmart, if he owns Walmart, he owns very little of Walmart. He may have a few shares in his stock portfolio, but he is not a substantial owner of Walmart. So there is a distinct relationship between the owners, the stockholders, and the employees. And because of that, many of the things that Jordan mentions in those larger businesses definitely can be deducted by those larger businesses, as long as they don't discriminate. If they basically do these types of fringe benefits, give these types of benefits to everyone in some kind of ratable, consistent pattern. We're going to provide this for all of our stock handlers because they've got to have strength in order to do their jobs well. You know, if they do something like that that's consistent and not discriminatory, then yes, those can be written off. Now, you can do the same thing in your small business for everyone who is not a substantial owner. So the problem you have in a nutshell is that definition of substantial owner for most of these programs is 2% or more of the company. So Stephanie, we don't know whether or not you have employees, but if you have employees, you very well may be able to have gym memberships and deduct them for your employees as long as you have them for all of them, but probably not for yourself.
Okay. That's really good. That's great to know. All righty. All right. Well, let's move on to the last one. This is from Jerome here in Kentucky. He sent another Wall Street Journal article that's talking about how higher inflation affects your tax return. And I know that the December numbers just came out yesterday, I think, saying inflation 7% year on year. So, and it sounds like they've adjusted some of the withholding tables, things like that. So maybe just talk us through generally, how does higher inflation affect your tax return for the prior year and also withholdings for the current year?
Hi, Jerome. Great question. Love this question. We're going to take about an hour and a half and answer it. So settle in. Here's the reality. I've been in accounting practices for a long time. And because of that, I've seen tendencies and trends in writing tax law that some of these young, handsome guys like Jordan just simply haven't seen yet, right? So the reality is the tendency over the last roughly 20 years has been to build into tax law what they call inflation adjustments. And they're automatic in the tax law. And they come in a lot of different forms and fashions. So I'm going to assume for a moment, to make this simple, that you're an employee, that you're working for someone else. So how does inflation affect you? Well, besides making you want to, cuss at everyone every time that you have to buy something that's now $2 more than it was last week, it affects you also in your taxes, because taxes are very much a matter on the federal level, especially. Kentucky does not work the same way, but they're a matter of having certain amounts of income that are in what we call brackets. And as your income goes up, so do your tax rates. So I'm going to use an example, don't know whether you're married or single. There's so much we don't know about your situation. So this example won't be accurate, but it will be accurate conceptually. So the first $17,000 of your income could be, if you were married, taxed at 10%. And then roughly the next 65,000 or so would be taxed at 12%. And then there's a bracket above that. Now that we're over $82,000 in my example, there is a bracket above that goes to 22%. And that goes on into the well over $100,000 worth of income. And so if you have $100,000 worth of income, you're going to have 17,000 taxed at 10%, and you're going to have the next roughly 65,000 taxed at 12%, and then you're going to have roughly about $18,000 taxed at 22%. And I can tell you that there are all kinds of reasons that my example is not specifically correct, but conceptually it is correct. So here's what happens. Every year, the $17,000 bracket gets increased by inflation. Well, for several years, their inflation was teeny tiny. So 17,000 might only go to 17,200 or 17,300. And then the next bracket would also increase in size a little bit. And it meant that you could make more and still pay at lower amounts. So that was the significance of that. And that's also, knowing the article you're talking about, that's also part of the point of the author, is that the tax tables are being adjusted up more because we're not at 2% or 3% inflation. We're at 7%. So 17 might go all the way to 18 this year. There'll be more dollars taxed at a lower amount. So that's good news, right? That means that we have a bigger bracket and lower tax rates that are going to be applied to your income. In theory, no question about it, your income should go down. Of course, the economic impacts are devastating, right? You're paying $1,000 more for gasoline. You're paying $2,000 more for food. Who gives a hoot about a little bit lower taxes when you're having to spend that much more of your paycheck, unless your employer steps up and gives you increases because inflation is so strong? So there are a lot of implications, but from a tax standpoint, it should drive down taxes. There are a number of other areas of the tax law that also are inflation adjusted. And I'll give you one example that I think everybody can understand. A business owner can write off vehicle expenses. And most small business owners will use a mileage rate for that. And that mileage rate in the past has been 57 cents a mile in a specific year. And it gets adjusted every year to a new rate based on, guess what? Inflation. But inflation is measured differently there. It's not the 7% number that Jordan's quoting that is overall inflation. Instead, it's car inflation. How much did cars go up in price? How much did gasoline and other operating expenses go up over the course of the year? And the answer is a lot last year. Gasoline alone is up, 50 to 60% over what it was a year ago. So my point in making that example is, I haven't seen those rates yet. Jordan, have you? But the 57 cents is likely to be substantially more. Could be as much as 70 or 80 cents a mile for people who can deduct auto expenses. I use that as an example because there are several areas in the IRS law that are tied to some type of inflationary adjustment. Standard deductions, which applies to virtually everybody now, those were adjusted. A married couple used to be $24,000. They're up around $25,000 now. There are a number of specific parts of the tax law that are tied to inflation adjustments. I will say that I think virtually none of them affect a taxpayer negatively. I think virtually all of them affect a taxpayer positively, as in lowering your tax. So it's a great question. And again, it would be really fun to list everything that's infected by inflation in the tax law. And that would very well end up being a very, very long conversation. But we won't go that and bore our viewers today. We'll make sure that we stay with the general answer. So good luck with that. I hope it works out. Jordan, you're muted.
Sorry. Yeah, one thing all I said was one thing I saw in the article. It looks like with withholding specifically, if you are an employee, your net paycheck, the amount coming into your bank account, should actually increase a little bit because your withholdings will go down a little bit, which will end up being a nice change. I know when the tax law change of 2017 came, that kind of shocked a lot of people because it went the other way. The withholdings went down a little bit, and people who normally got a refund either got a smaller refund or got had to pay. So that's one bright side. I mean, if we're trying to find a silver lining of 7% inflation, I guess that's one. So I'd rather have lower inflation, but I will take what we can get.
Gordon, to that point, in theory, the lower taxes I mentioned earlier are built into the tax withholding tables. So if your taxes are going to go down $300 because of all these inflation adjustments based on tax rate tables, mostly tax rates themselves and those brackets, then in theory, your net pay should go up $300. In reality, it never works exactly cleanly. There's always some issues. And from that standpoint, how much will it affect what your normal tax results are? There are so many variables that it's next to impossible to predict. But I would suspect, based on even a 7% inflation year, that the differences are not going to be substantial. What will be substantial is, did you have a child? Did you make more money? Did you make less money? Did you change employers? Did they withhold the same amount? Are the child tax credits renewed? So many things that could affect your overall bottom line. But Jordan brings up a good point. The government intends to try to give that to you in your net paycheck to recognize that these taxes will be less next year.
Yeah. Okay, cool. Well, we've got one more. You actually just mentioned it. And I know we talked about this in a training earlier this week. I think it'd be good to go ahead and get out in front of some of this with the child tax credit. Can you speak a little bit to a parent? This wasn't a question we got. This was just one I think would be good. Speak to a parent who got some of these advanced child tax credits and how that's going to be reconciled. I know it's a little daunting, but maybe just a general overview, because I know normally the child tax credit is only dealt with at tax time. And for this past year, it was a little wacky. So,
yeah, no, that's a great question, Jordan. And it's one that I'm going to gladly give a succinct answer. And when I finish, you're going to say, that was succinct, really? But there are a lot of facets to this. A little bit of background will help. Because of COVID, certain political persuasions have suggested that we need to get cash into people's hands. And again, you could argue whether that's a good idea or a bad idea. I'm not sure it's even a party line issue, because there are people on both sides of the proverbial aisle in Congress that will argue for and against these types of advances and payments coming out of the government. Some will argue that we have 7% inflation because of it. So there are lots of arguments to be made about whether it's a good idea or a bad idea to simply push cash out of the government into various taxpayers' hands. It's also our money, right? They get the money primarily from taxpayers. So again, all kinds of philosophical backgrounds to what I'm getting ready to talk about for a few minutes. But what I will say is, this child tax credit advancing, which is what started last July, it was an attempt to try to put some cash in individuals' hands. And COVID's being blamed for that. Whether or not it is the right blame in the right sequence of events, and whether it's more of a political ploy or a true benefit that should be advanced, all of that we could argue about, depending upon who you are and what your political persuasion is, for a long time. That's not the point of the answer. The point of the answer is that's why it was done. So what they did was they simultaneously raised, for most people, if your income's high enough, if you're a married couple at $180,000 or so, you don't get this extra benefit. But there has historically been a $2,000 credit for a child, credit meaning coming directly off of your taxes. So it will add to your refund or reduce what you owe. So there's been a $2,000 child credit for every child under the age of basically 18 now. And so with that in mind, if you've got 3 little ones at home, you were getting $6,000 up through 2020. In 2021, again, as part of COVID relief, these credits were increased. And if your child is 0 to 5 years old, they were increased to $3,600. If your child was 6 to 17 years old, they were increased all the way up to $3,000, a little bit less for the older kids because somehow Congress in their wisdom decided that it cost less to take care of an older child than it did a younger child. I'm suspecting that none of these folks have ever been parents because they obviously got that one wrong. But all of that simply to say the amounts went up. Then the second part of making the amounts go up was, hey, let's give some of this money to the parents. So based on your 2020 taxes, now in Jordan's case, Jordan had no children in 2020, but he and his wife are now the proud parents of sextuplets. They're not really, I'm making this up. But the reality is he wouldn't get any of these child tax credits because in 2020 they had no children. But if you did have children on your 2020 returns, starting in July, the government said, we're going to figure out your credits for the year, and we're going to give you 1/12 each month for the last 6 months of the year. Now, let's make the math easy here, right? That's half the year. So basically, you were going to get the credits for half of whatever was going to be on your tax return for 2021 if you had the same number of children in 2021 that you had in 2020. And therein lies the rub, right? May have more children. Maybe you're a divorced parent and you only get to claim your kids in some years. Well, they were going to advance the credit to you regardless. So many of our clients have gotten $250 per child, or if the child was under 6, $300 per child for 6 months out of the year. Feels pretty good when you get those checks, right? Maybe it's enough money to go out and make a car payment or possibly even buy a Ford hamburger with the inflation rates. Whatever it is, it feels pretty good to get those. But now it's tax time. And those amounts that were paid to you, there's going to be a special form. Jordan, do you remember the form number? Was it 6749? It's something very similar.
I'll look it up real fast.
It's a new form, and we'll get you that number. But you're going to get this in the mail, and your tax professional, or you, if you're a TurboTax person, are going to need that form in order to file your taxes. Because if you have Johnny, Missy, and Timmy as children, and their credits are $9,000, and you got $4,500 of that advanced to you during July through December last year, you only get to claim the other $4,500 at tax time. So the point is, what you are used to claiming on your return, a full child tax credit, isn't going to be there this year. It's going to be less than what it has been in the past. So I already know the questions that our clients are going to ask us. I'm used to getting $10,000 worth of refund. I only got 7 this year. What happened? And they are trying to figure that out. And in many cases, it will be the fact that the child tax credit was already advanced to them in cash. So in effect, it reduces their refund or increases what they owe at the end of the year. Now, the Build Back Better bill, which has gotten a great deal of press. Unless you simply don't follow any of these things, you've probably heard of it. It was a bill that was advanced by the Biden White House and was attempted to pass before Christmas so that it would extend the same arrangement into 2022. The bill did not pass. There's not enough support to get it through the Senate. And because of that, these payments should have ended, and I believe did, at the end of 2021. Will Congress do something specifically with this issue to continue the payments? Stay tuned. It hasn't happened yet. There is precedent for these types of things happening where that they take a specific piece of a bill and say, well, that's important. We're going to simply write legislation that we can all agree about to take care of that one piece. But for now, it was a 6-month experiment that is over.
Yeah. Looks like it's letter yes. 6419.
I was close
Yeah.
with memory. So the point is, watch for that letter in your mailbox. Make sure you have it in front of you if you do your own taxes at tax time, or If you use someone else, make sure you take it to those professionals so that they know how much you got. Because you did have the ability to get these payments and you did have the ability to stop these payments. Some of our clients did not want them. And for a limited period of time of a couple of months, you were able to jump on the IRS's website and say, please don't send these to me. And the IRS would stop sending them. So no one is going to know specifically what you got except for you.
Yeah.
And the IRS will confirm that in these letters.
Yeah. One thing that I foresee is the person who, some people really struggled during COVID, but all of us know people who have just done really great. And if they're basing this off your 2020 tax return, but you blew it out of the water income wise in 21, you're going to have to pay that money back, right? If you did get some of these advanced credits.
Yeah.
So just be aware of that if your income jumped. Yeah.
I think the dynamic, the best way to explain it is, again, it's about $180,000 for a married couple. It's about $90,000 for a single individual with kids. Not exact. Those are my rounded off numbers. But once you climb over those income limits, you no longer get the additional money. You still get the $2,000 base that was there in 20 previous years. However, suppose that you are over those limits, you get to claim $2,000, but perhaps $1,500 or $1,800 has already been paid back to you in these payments. That's going to mitigate substantially what you can claim on your tax return. And so again, Jordan's sextuplets should be putting $12,000 on his return. That's what he's used to. But if he's already received half of that, he's not going to have nearly as much to claim as usual. And he's not only received half of the credit, but he's also received half of a higher amount of the credit, because based on age, the credit was increased to $3,000 or $3,600. So one more example, just because I believe examples really clarify a lot of this. If I have one child that's 10 years old and he was on my 2020 return and he's going to be on my 2021 return, I would have gotten $250 per month for 6 months, $1,500 advanced to me in the credit. If I'm under those income limits, I get to claim $3,000 for him at the end of the year. But I have to, in effect, reduce that by the $1,500 that's already been paid to me. Therefore, the other $1,500 is what I get to claim as a credit. Last year, 2020, I got to claim $2,000. So in that example, the taxes are not affected much. They're affected by about $500. If I'm above those income limits, my $2,000 credit is still $2,000 because I'm above the income limits. The $1,500 reduces that. I only get $500 impact on my taxes this year, where I'm used to getting $2,000 impact in previous years. I'm going to feel that, especially if I've got sextuplets like Jordan, right? So I'm going to feel that not once, but I'm going to feel that 6 times. So it's going to have a substantial impact on my tax return if I have multiple children. And the whole complexity goes crazy if you had 3 kids in 2020 that you can only claim in even years because you're a blended family or someone with a divorce situation. Now all of a sudden you have no credits when you file your tax returns in 2021, but you got the payments anyway. Yeah. So now you add all of that back to your tax liability at the end of the year. So it's going to be a complexity. That's the message I'm really trying to send out to you. Make sure you deal with it. If you file your own taxes, make sure you communicate it to your tax professionals. Yes, I got the payments. Yes, I got all 6 of them. Yes, here's my IRS notice letter saying that I got all 6 of them. And then we can get it right, but don't be surprised if your tax results change because of it.
Yep.
And that's
great.
That's the succinct version. We can talk about it a lot more if you're not already asleep.
Hopefully you don't have sextuplets like me.
There are just not too many sets of those here in Louisville, Jordan. So,
yeah. Well, I think that brings us back to a common theme of a lot of our conversations with clients is you need a forward-looking accountant. You also need to be forward-looking as you look at prices going up. One way that you can be super efficient is with taxes. So make sure you're reaching out to someone who you're already working with. Feel free to reach out to us. You can reach us on our website, which is in the description of the video. And we just need to be forward looking. I mean, it's great to report to the IRS what happened in 2021, but come April, you know, that's going to be at least 4 months old, if not more than that. So you need to be working through all this stuff throughout the year, as boring as you might think it is. And I think people use that as a cop out because you get into the numbers with some clients, and these dollars mean a lot to their families. And sure, the taxes, it's fun to say, oh, taxes are boring and whatnot. But, you know, if you can store away an extra $10,000 in a retirement account or 529 or something like that, that you didn't have because you would have had to pay it to the government, that's a big deal. So use all this to motivate you to, if you didn't look into your taxes last year and you got a big surprise coming this, you know, for 2021 taxes, you know, it's new year, time to make a change if you'd like. So feel free to reach out to us. So cool. I think that's good. Wrap up. You got any other comments, Rick?
Oh, I do. I have one that I just absolutely have been wanting to make ever since the child tax credits come up. I understand statistically that births are way up because so many people were working from home. So that may be a reason why that you've ended up with no real tax from this.
I thought I saw that we're like in a declining population.
Oh, but there is a COVID window there, Jordan, and
that's true. That is true. The COVID babies.
Yeah, I suspect that at some point in the future, that generation will be called the COVID generation. So we'll see.
Yeah. Well, hopefully this tax credit turns it around, because I think right now we are in population decline at like 1.7 children per family. So
yeah,
that's where we'll end off on your tax conversation. Go have more babies.
That's right. Yeah, it's always cool. Tax planning strategy. It only costs about $100,000 to raise them till age 16, and the government will give you back, you know, maybe as much as, I don't know, $30,000-$40,000 in tax credits. So what a deal, right?
There you go. Yeah, quite the deal. Cool. Yeah. Well, hopefully you guys found this intriguing and helpful with some of your questions. And yeah, if you guys have your own questions, you can just shoot those over to me. My email is jguess@aia-cpa.com. If you could put question in the subject line and give me your name, where you're at, that'd be great. And we'll try to work it in to the next episode. So thanks so much for watching, guys. See you next time.
Always enjoy your questions. Please keep sending them. Thank you.
All right. See you.